Ladies and gentlemen, good evening. Thank you for joining me. What I want to talk about today is something important, something many silver stackers are missing because they're focused on the metal itself and not the broader system behind it. I want you to step back, widen the lens, and see what the system is doing. Because when you do that, you'll see why December 2025 may not just be another turning point, it may be the turning point for silver. When we take a step back and look at the foundations of the economy, we find that it is not a smooth, predictable machine, far from it. Rather, it is a complex system of interlocking forces, and when one of those forces accumulates strain, the system begins to shift. At the core of that shift is the structural imbalance, the kind of disruption that doesn't just show up in a headline, but in the silent buildup of pressure beneath the surface. First, let's talk about what I mean by structural imbalance. In our system, you have supply and demand, you have debt and capital, you have monetary policy, and you have confidence. These parts are always interacting. When one leg becomes overstretched, say debt grows faster than income, or supply becomes constrained while demand rises, you build up an imbalance. Over time, this imbalance can accumulate until the system's fault lines begin to crack. What is easily ignored when things appear steady becomes glaring when things break. Take debt, for example. When borrowing proliferates because interest rates are low, and when credit is easy, the system can appear to be accelerating nicely. Growth, leveraging, asset inflation. Everything seems all right. But if the growth of debt outpaces the growth of the real productive capacity, you have built-in risk. At some point, you either must service that debt, roll it over, or you must restructure it. The larger the debt burden becomes relative to the system's capacity to carry it, the more fragile everything becomes. In that environment, policy responses, which once worked, begin to have unintended consequences. That's part of structural imbalance. Another example, supply constraints paired with evolving demand. Some industries are unique in that supply doesn't respond linearly to increasing demand. When demand shifts because of structural reasons, think technological change, industrial adoption, environmental regulation, the supply side may be slow to catch up. And when you add the monetary and credit backdrop, when real money is losing value, when investors are seeking alternatives, you have a scenario where demand for certain assets or resources accelerates while the system is strained. The structural imbalance here is the mismatch between the evolving demand and the lagging supply plus changing monetary backdrop. What happens as these imbalances accumulate? The system doesn't just drift forever, it approaches a threshold of instability. At that threshold, the behavior of markets, economies, industries changes. The hidden vulnerabilities become exposed. People who were comfortable assume continuity. They're surprised when continuity doesn't hold. That's the disruption part, the phase when the accumulated structural imbalance shifts the system from one regime to another. It could manifest as inflation rather than deflation, or as a shortage rather than an oversupply. It could show up in markets as sudden moves rather than gradual ones. And disruption is not merely noise. It's meaningful precisely because it marks a regime shift. The system's rules change. The portfolio you built under one rule set may not hold under the new one. The point is not to fear disruption, but to be aware of it. Because when disruption appears, it is a consequence of structural imbalance, that buildup of unseen pressure, and you have to be prepared for it. So in practical terms, you want to identify the key places where imbalance is greatest. You want to ask, where is debt high relative to income? Where is supply limited but demand rising? Where is monetary policy stretched? Where is currency confidence being challenged? And you want to think about how those imbalances may interact. Because it is rarely a single thing that triggers disruption, it's the intersection of many pressures that strains the system. Consider that when supply is constrained and demand picks up because of structural trends, and meanwhile credit is cheap and money is being inflated, you have a potent mix. The system's fault lines, whether in commodities, currency, assets, or industrial supply chains, become points of failure. And that means that systems built for the past regime may find themselves vulnerable. It's not about timing precisely the day, but about recognizing that the structural buildup is real and that the odds of disruption increase. One final thing, in such a world, staying passive is risky. The assumption that this time it's different is dangerous because structural imbalances don't respect comfort zones. They respect physics, mathematics, and human behavior. And humans tend to extrapolate recent calm into future calm. And that's often when they are most wrong. The old rule, set works until it doesn't. So when you step back, you see that disruption is not independent of imbalance. It's the culmination of it. The structural imbalances give shape to the disruption. They create the context, and if you grasp that, you can shift your perspective from waiting for the next headline to preparing for the next regime. Because in that regime shift lies both risk and opportunity. When recognition begins to build, when markets, institutions, or a broader audience start to wake up to a latent truth, there's a moment of stillness. It's subtle, it's quiet, and then, if the forces are in place, recognition turns into momentum. The transformation from awareness to force is one of the most important dynamics in markets and investing. First you see, then you act, and then others start to follow, and that's when things begin to move fast. The first stage is acknowledgement. An idea or condition exists quietly in the background. Perhaps supply constraints are tightening. Perhaps monetary policy is shifting. Perhaps an asset class has been dismissed for years. Because it's forgotten, neglected, undervalued, nobody expects much, and so nothing happens. But when someone begins to map the machine, to see the interplay of forces and recognize what is out of alignment, that creates the spark. At that moment, you have the raw insight. Ah, the system is different. This node that many ignore is emerging. That spark alone doesn't guarantee a fire, but it is necessary. Then comes the beginning of participation. The early movers, discretionary, curious, daring, begin to deploy capital, shift positions. Their action broadcasts a signal. This isn't just a theory anymore. Recognition translates into investment decisions. When enough of those early steps happen, you begin to see movement in pricing, shifts in flows, widening awareness. Momentum is incubating. It isn't yet full throttle, but the path is being paved. The transition from recognition to momentum happens when two conditions align. One, the fundamentals or structural forces must justify it, so recognition is rooted in something real. Two, the psychology must shift enough, participants must engage, believing that continuation is possible, and their actions feed into others. When people see someone else acting and the price or market begins to move, they begin to believe they should act. That's when the self-reinforcing dynamic starts. In essence, recognition becomes visible, and visibility attracts participation, which fuels more visibility, the classic feedback loop. Once the momentum is underway, it gains its own energy. New participants pile in, not always because they fully understand the original case, but because they see the move unfolding. That is when the rate of change accelerates. The market begins to preempt itself. The expectation of future recognition and participation causes today's flows. What was latent becomes manifest. What was quiet becomes loud. What was slow becomes fast. And that acceleration can far outpace the original structural drivers. Momentum becomes a force multiplier. It is important to understand that momentum isn't endless without end. It can slow, reverse, exhaust, but while it carries you, momentum is what turns opportunities into large moves. The early recognition advantage is highest when few have marked the transition. If you wait until everyone knows, the move is in the past. The sweet spot is when you've seen the recognition, positioned before full momentum, and then ride the wave as the broader market joins in. Applying this to asset classes or markets, suppose an asset has been down the pecking order. You recognize that industrial demand is rising, Supply cannot respond quickly. The monetary backdrop is loosening and investor interest is marginal. You see the structural case. Then you begin to detect early signs, rising mentions in research, inflows picking up, inventory data tightening. Those are recognition cues. Then you act accordingly. The first wave of participation sets the stage. As price begins to respond and others begin to validate and join, momentum takes over. In that phase, the logic shifts. You're no longer just looking at fundamentals, you're looking at the dynamics of behavior. How many people believe? How many flows are there? How much supply is left to respond? What are people missing? What are the second-order effects? Because when momentum is in force, more of what matters is psychology and positioning than just the original case. You want to ask, when will people not act? When will they be forced to act? How will the narrative shift? Because the variables that drove recognition shift into variables that drive the pace of momentum. To be clear, you don't want to rely on momentum alone without structural underpinnings. There must be something real to recognize, but you also don't want to wait until everyone recognizes it because then you're late. The tension is in being early enough to hold conviction, yet flexible enough to participate when momentum picks up. In my view, the maximum return comes when you combine recognition, the insight, with readiness, the capacity to act just prior to momentum. Finally, this is a game of probabilities and readiness, not certainties. Recognition does not always lead to momentum. Sometimes the spark fizzles. Momentum sometimes leads to euphoria and then collapse. But if you understand the sequence: recognition, early participation, momentum, acceleration, and if you see the cues early, you can position for asymmetric outcomes. Because when momentum engages, the move can be large and fast, more than the incremental logic might suggest. In sum, the most powerful moves in markets happen when recognition of structural change leads to participation that triggers momentum, which then outpaces the underlying drivers. If you can step back, see the recognition phase, act before the masses, and stay prepared for the momentum phase, that's how you capture large moves rather than just witness them. When you reflect on timing, you realize that it's not just about when something happens, but about why it happens at that moment: the alignment of forces, the culmination of cycles, the snapping of structure into motion. And when you consider how these things work, you begin to see why a specific point in time can become a pivot, a change point where latent pressures release, recognition shifts, and momentum begins in earnest. In many systems, economies, markets, even societies, change doesn't occur evenly or gradually. It accumulates, imbalances build, expectations change, the structure becomes stressed. And then, when several moving parts align: supply, demand, policy, sentiment, the system doesn't just drift into a new state, it flips. That is the moment of pivot. Once you understand that, you see that timing is everything. Not because we can predict the exact minute, but because we recognize the window when many variables converge and a shift is much more likely. Why does such a turning point matter? Because prior to the pivot, the rules of the prior regime still largely apply. Supply responds in certain ways, demand grows at expected rates, policy tools behave normally, participants act in habitual patterns. After the pivot, the regime often changes. Supply might respond differently, demand might accelerate, the monetary backdrop may invert, and participants may be caught off guard. Being in the right place just before that change matters more than being right a year too early or a year too late. So when you map the forces: debt cycles, monetary policy, industrial demand, investor psychology, you ask, when are they all pointing in the same direction and building toward an inflection? Because once they do, you have a pivot window, not just an isolated event. That window is where preparation beats prediction. You cannot say exactly, on December 15, this happens, but you can say, late year, the cycle's rounded the corner. If supply is constrained, demand is picking up. policy is turning more favorable, and inventories are thin, then we are moving from accumulation to activation. In that sense, the calendar becomes more than a label. Year-end isn't random. It matters because portfolios are reset, fiscal years close, inventories are reviewed, institutions reposition. It is a moment when many decision points, human and institutional, happen simultaneously. That synchronicity accelerates change rather than diffuses it. So when you recognize that December of the year may encapsulate that synchronicity when structural imbalances are ripe, recognition is dawning and momentum is primed, you treat it not as a singular event but as the hinge of the regime shift. Importantly, timing does not mean being passive and waiting. It means being structurally ready. It means positioning ahead of the window, anticipating the convergence, having conviction, but also having flexibility. Because once the pivot begins, things can move more quickly than one expects. Price changes, flows, sentiment swings, they often happen faster than the structural logic suggests. The change of regime catches many off guard. That's why what you do in the weeks and months leading into the pivot matters as much as what you do after. What is the risk of mistiming? Too early means you bear cost of capital without returns. You face early volatility. You may damp your conviction. Too late means the move is already largely in motion and you are participating, not capturing. The sweet zone is when recognition is just beginning, structural forces are thickening, and the calendar window is about to open. In practical terms, that means knowing that timing is finite. From having identified the window to execution to management, once momentum builds, that is the pathway. In these systems, you must also consider that the pivot often marks the end of one regime and the start of another. It may mark when liquidity shifts, when policy pivots, when roles of assets invert. What was ignored becomes prized, what was prized becomes questioned. If you anticipate that correctly, you don't just ride the trend, you exploit the reset. You use the pivot, it becomes a point of leverage, not just participation. That is how large returns are obtained and large risks are avoided. Let me emphasize one point. While you cannot know the exact day, you can know the window. You can know when all the major pieces, structural imbalance, industrial demand, supply constraint, policy flexibility, investor psychology are present. Once you see these converge, you act. You don't wait for the perfect signal, you position with clarity. Because the calendar doesn't give an endless warning. The pivot window passes. When it closes, either you acted or you missed the ride. Finally, when you view time that way, not as a continuous smooth flow, but as windows of change, you begin to think differently. You no longer ask, will this move happen? But when will the move happen, based on cycle plus structure plus psychology plus calendar, and you prepare accordingly. Because the difference between average and exceptional outcomes often lies in being in the right place at the right time, not just in being right about the idea. So when you reflect on the coming December or any defined time frame with structural conditions in place, don't treat it as a forecast of a day. Treat it as the pivot window where the system shifts. Treat it as the hinge on which the next regime may swing, and position for that, because timing matters, not because you've predicted a date, but because you've understood the forces, recognized the window, and are ready. In closing, I'll say this. Many silver stackers don't realize how massive December 2025 may be, because they're looking at ounces and dollars rather than cycles and systems. If you raise your vantage point, you'll see December 2025 as a potential pivot, not just another month. Be ready, pay attention now, position accordingly, because when recognition meets structural imbalance and timing, the market doesn't just move, it can leap. Thank you for your attention. Let's prepare not just to observe the change, but to participate in it wisely.